So good afternoon, friends. From PIFAA, we have Quantum Mutual Fund and Mr. Chirag Mehta from Quantum to be presented to you today. It gives me great pleasure to welcome Mr. Chirag Mehta from Quantum Mutual Fund. He has been ranked as the 4th best fund manager in the world under the age of 40 by CityWire. He has more than 18 years experience in managing commodities, and he specializes in the field of alternate investment strategies. He's a qualified CAIA, meaning Chartered Alternative Investment Analyst, and has also completed his master's in management in finance. He currently manages 5 funds, largely in the field of alternate investments. It includes Quantum Gold Fund, a multi-asset funds, an equity fund of funds, and the ESG fund. He has been with the Quantum Group since 2006 and has a hands-on experience in commodity market as an intern and later. So friends, we have a unique combination of expertise here, particularly the atoms of his interest and passion are gold. He has been a keen observer and student in gold market moves, and we are all very eager to learn from him the art of asset allocation pre and post COVID. Friends, we are all aware that those who were alert and those who were still courageous, they have been helped a lot with the current bull run. At the end of it, many of our investors are sitting on a lot of gains in equity. What do you do now? Whether we shift some part of the gains to other assets, or alternatively, those of us who have not been in the equity, what do you do today? How should the asset allocation go on? Let's seek answers from Chirag Bhai for all these anxieties of ours. And with this, I hand over to you, Chirag sir. Please give us the benefit of your experience and expertise in alternate asset classes and asset allocation. Thank you.
Thank you, Bhushan sir, for that kind and generous introduction of mine. And I hope, firstly, that you all are doing well. These are difficult and tough times that we live in, and I hope you all are all safe and often healthy. So with that, I think we can start today's session in terms of how should asset allocation change, or should it change in the first place when you look at COVID as a shock and post-COVID, how we can go and navigate asset markets by building our Lego blocks of portfolio. So if you look at COVID, the second wave has been ferocious, right? And that's not only true in India, that has been true across the globe. We had seen second wave in Europe, in US, and all of these were significantly larger than what we saw in the first. In the first wave, governments were not knowing what to do. And in that fear, they all started with lockdowns, and that kind of killed the first wave significantly, and it didn't allow that spreading of the virus. But the second wave has been significantly large because virus was still there. We all started moving out, and the virus has now caught on us. So we have it's spreading significantly. But look at India. India, in absolute numbers, it has been significantly larger than what we have seen anywhere. And that has to be obvious because the population in India has been significantly larger than what you see in most of the developed markets. But have we made the right policy steps, or have we failed towards that, right? Look at these comparisons. This is just a second wave. The blue bars are the first day of the second wave, and what it is now. So if, for example, in India, we were testing 142,000 people on a daily basis. Despite the spread, we are still only testing about 200,000 people a day, right? So we are not testing enough. And testing, if you look at compared to what we see in Europe, it's significantly larger than what we see. This is all based on per million people, right? So how many tests they are doing per million people. So we have taken into account the population measure as well. But if you look at France, Italy, Switzerland, UK, they are testing multifold of what they did when the second wave started. So we are far, far lagging when it comes to testing measures. And when we are not testing, the virus is out still in the open. People may be asymptomatic, but they are still carriers of that virus, and the virus keeps spreading across, right? And because of this low testing, the number of cases that we see are kind of lower and to an extent underreported, right? If you look at what kind of cases that we have seen per million people, India is still far lower than what you saw in France, Italy, Switzerland, UK, because they were testing more people. So if we adjust our test to what we saw in the developed world, like in Europe, our cases would be significantly larger. And if cases are larger, then obviously the deaths will be larger. The impact, the dreadful impact of the virus is in terms of the deaths. And that is why you see the number of cases or reported deaths in India versus what you see reported from certain cities in terms of the crematorium counts, they are far larger. That really tells you that the deaths, what numbers that we see, are significantly underreported, right? So we have a massive crisis at hand, and the kind of the policymakers look at this data and say that it's not significantly larger, but they fail to understand that we are kind of not testing, and therefore we are underreporting in all measures. One way that crisis will end, the virus will go off. Either we have a herd immunity built, or we vaccinate a lot of people. Either the virus catching on us, and therefore the impact will be far, far, far larger, or we vaccinate a lot of people, and therefore the impact of the virus is lesser to an extent and goes off in that manner, right? So look at vaccination progress. We are significantly lower as we stand today in terms of the vaccination that we have done. These are both the doses to the population that we would have given is around close to 2% at the best. Whereas if you see other countries like US, UK, France, Germany, Brazil, they are far higher than what we have done. UK is an excellent example of how they fought the war, and I think they are kind of moving towards be victorious. They kind of put in severe lockdowns, and in the meanwhile, they kind of made sure that a lot of population gets vaccinated. And because of that, they ran the vaccination drive so aggressively and kind of vaccinated so many people in that 2-3 month period. They have a much better place, and they will open up much faster. And therefore, if you look at the British pound, which is their currency, it's one of the strongest currencies today, right? So all those economies who are doing far better will be faster to open up, and therefore the investments there will do much better, because money will be chasing those markets, because they will show higher growth because they are opening up. So India lacks significantly. So we don't know how it's going to pan out in terms of policy measures, but we think that it's going to be, no one is ready to take that dreadful call in terms of closing down, vaccinating people, and then kickstarting the economy. That's not happening. And therefore, we will go from start, stop kind of measures, and it will linger around for a much longer time unless we see a decisive policy measure where you are locking it down. And in that locking down, you are taking measures to vaccinate people. So with that backdrop, which is one of the important factors affecting all asset markets today, let's look at each of the asset classes, what we are seeing in each of them, how it's going to pan out, right? So look at fixed income. Fixed income, what is happening is there is a lot of government supply. The government borrowing has gone through the roof because of the deficit that they're running because of COVID. revenues are taking a hit, have taken a hit. Of course, last 2 months it's been a little better on the GST collections, but otherwise we were way short of our revenues. And what is helping is the RBI is buying a lot of bonds from government. That is capping the yields, right? That is not allowing the bond yields to move higher. So if you look at the chart on the right hand side, if you look at the 10-year, because of higher government borrowing announcement, if you see the blue line had started moving up from December, January onwards, right? And now RBI looking at these yields has come in very aggressively saying that I won't allow yields to rise significantly. And they have announced a big borrowing or big bond purchase program. And therefore, the yields have again started coming down to around the 6% mark, right? So one end, you have pressure of government borrowing, and the second pressure is from inflation. If you look at commodities across the board, be it agri commodities, be it metals, be it oil, all have risen significantly, and we are all seeing the pinch of that commodity price increases in form of inflation. So inflation is on the move and will likely stay because there have been certain supply side constraints because of COVID, and supply is difficult to ramp up in a short span of time, and demand has gone up because governments have pushed in a lot of money in the system, which is going to people, and people are consuming out of that money. Like in the US, they have given checks to each and every citizen saying that because of COVID, you were hurt, take the money and do what you want to with. And therefore, that is ending up in terms of consumption and consumption increasing, leading to commodity prices increasing, right? So you have the supply pressure of high government bonds, you have inflationary pressure, and RBI is fighting both of these menaces in saying that still I will not allow bond yields from rising. So overall, there are two counter measures which are leading to a range-bound movement in yields, and which is unlikely to change. So if you look at the spread between the 10-year bond and the 1-year, the short end of the market has been significantly larger. And whenever we have seen at a 1-year falling at such low levels, it's kind of indication that yields are kind of moving higher, right? We had seen in 2003-4, we had seen in 2009-10, and we are seeing that now. So there will be upward movement in yields once RBI kind of comes to the fact that economy started to recover. They will ease off their pressure in terms of allowing the bond yield to gradually rise. So for now, they have to keep the cap because economy is not in good shape. But once that starts, the yields will slowly start moving up. So what all this means for bond investors, all those invested in bond funds, the yields will slowly rise, and therefore the capital gains that you were seeing all this while will turn into capital losses to a small extent. It won't be significant because I don't see a runaway increase in yields, but it will slowly start inching towards 620, 25, 650 kind of levels over next 1 year. So US bond investors or your clients are invested in bond funds, don't expect very high returns like what we have seen in last 2-3 years. It's not going to materialize in terms of significant returns from bond funds because there won't be any capital gains over and above the bond yields which have already come down from 7-8% to 6%. Therefore, the accrual is lower, plus the chance of making a capital gain is lower. And therefore, you will have to be contented with a normalized lower return than what you saw in last couple of years. So that was on the bond side. Coming to the equity side, what were we seeing in equity markets overall? So it's a given fact that India is a fast-growing economy. It is one of the fastest growing economy and much higher pace than what we see in various developed nations like US, Europe, Japan. So we will rise much faster. So what we were around 3%, 3 to 4% of the global economy, we will rise to about 30-14% of the global economy going forward, right? For next 20-25 years. So we will grow and become a larger share of the global world. And the glide path to this higher share of growth is not going to be the 8, 9, 10% growth that everyone talks about, right? India will not be able to achieve that 8, 9, 10% unless we see significant reforms in India on various sides, right? We don't have that infrastructure to allow you to grow at that 8, 9, 10%. So what we think, India, or since 1980 till now, last 40 years, has grown at a rate of 6.1% on an average, right? And we will continue despite what happens in terms of who comes to power, which government is there, be it coalition, be it single party going forward. We will continue at 6.5% of growth rate. So if someone tells you that India is growing at a much faster rate, you need to pinch yourself and ask those questions. How is it possible to grow at that higher rate on a constant basis? This year it could be higher rate at 10, 11%, but normalized basis, it will always be around 6.5% in that range, not beyond that, right? And there are some other reasons why it will be. If you look at China, for example, if you look at the orange line on the left-hand side chart, that really tells you that the China capital had been very, very constant, about the 10%. The capital growth or investment growth was much higher, above the 10% mark for a fairly long time. And that is why they had very sustained high growth for a fairly long period of time. If you look at India, same thing for India, the capital, it's so volatile. Sometimes you have a 6% growth and sometimes you have a 12% growth. It's not like China. For a fairly long time, like 10, 12 years, it grew above the 10, 11% mark, right? We don't have that stickiness in terms of investment and capital formation, which will allow India to grow at that high rate. So always believe that India will keep growing, but that growth rate will always be around 6.5% and not higher. What does this mean? That given that India will grow and keep growing at a steady rate because of the sheer internal consumption that we have, there will be flows that will come to Indian markets, like we have seen China, because China is now slowing down in terms of growth. But as China slows down, people are also looking at alternatives to China. And the biggest alternative they have today is India, right? So India will keep growing and therefore attract a lot of flows towards India as people look for alternatives to China. So far, Chinese investment growth or foreign investors pumping money in China was much higher. I think India is now going to leapfrog as people slow down their investments in China. So it will be both a combination of equity flows and a combination of debt flows and also foreign direct investments, FDIs, into direct buying companies, projects, those kind of things. And these investments, because of the high growth, they will be chasing higher earnings. The earnings potential of companies is what they will be looking at. And for that, we have been far, far better and far, far consistent in terms of corporate earnings growth. Higher GDP means higher profits. Higher revenues. Higher revenues translate to higher profits. Higher profits translate to higher earnings of these companies, right? If you look at the math, how it works out is, the economy is growing at 6.5%, which is likely, I showed you that chart long term, that since 1980, we have grown at 6.1%. So our assumption is India will keep growing at 6.5% for next 10, 20 years. India will have an inflation of around 5.5%. So nominal growth is nothing but the real GDP growth plus inflation, which is around 6.5% plus 5%, 11.5%. So the GDP growth of the economy is around 11.5%. If economy is growing at 11%, the revenue of companies in the economy will also grow at, say, 11.5%, at least at the growth rate at which economy is growing, right? If revenues are growing, even if I don't incorporate any efficiencies that the companies have or will make in the future, profits will also grow in line with revenues. It's usually that profits grow higher than revenues, but even if you assume that profit growth is equal to revenue growth, then profits will grow at 11.5%. And that is the average profit growth of the economy, of average companies. And if you are invested in better companies than the average, right, then you should be making more money or more profit than the average companies. So we take typically good companies will at least make about 2% more profits than typical average companies in the economy. Therefore, those companies will increase at 13.5%, 2% higher than 11.5. And if earnings are increasing for these companies and stock markets reflect nothing over the long term, but earnings growth, then your earnings of these companies are growing at 13.5%. And therefore, the stock markets will reflect the 13.5% growth. So the long run, you should expect 13.5% growth from good companies you're invested in Indian markets. And therefore, if a fund is investing in able to pick good companies in the economy, it should give you this kind of return. So current market, if you see, it looks very, very stretched on a PE basis. The price earning ratio, how we measure the stock market valuations, the average is around 20 times, and we are today at 42 times. What this is masking is the fact that because this PE ratio is made up of earnings of last 12 months. And if you look at last 12 months, the first quarter of last year, the financial year, was a washout year because of the lockdowns, washout quarter for the lockdowns. Therefore, this earnings growth is not a normalized earnings growth that we are looking. Once we are past this quarter, you will see this PE ratio that we are seeing at 40, 42 times will come down dramatically, because that earnings growth where there were no earnings will go off, will get knocked off, and you will be looking at the next 12 months, or last 12 months. So this expensive valuation that you see is masking the reality, and therefore markets are not really that expensive, though they are expensive as compared to historical standards where you see the average 20 times average of PE. But still, if you knock off, this will come down dramatically to maybe say 28 times or 30 times, given earnings growth will be at least over last 12 months will at least be around 15-20%, right? Mid-cap PEs are far more expensive, and there is still the impact of COVID will be much longer in these companies, and therefore that valuation will take its own time to correct faster. So the larger cap segment will kind of becoming inexpensive valuation much faster as compared to the mid cap counterpart. So what we staring at in terms of equity market scenario is the lockdowns that we are seeing are less stringent than what we saw last time. It's more localized, more state government derived lockdowns as compared to the national lockdown that we saw last year. Companies are still functioning because factories are being allowed to function, though at limited capacity, but they are still working as opposed to last time that they were not. Corporate balance sheets are better because they have reduced their debt. They have liquidity at hand because they know that situation is not that easy, and therefore they have some liquidity at hand. They have done a lot of cost control and looked at business continuity, so they are in a far better shape in terms of their margins. So to absorb that shock, they can. Banks and finance companies have raised a lot of capital in the last 1 year, and therefore the capitalization is much better as compared to last 10 years because they know the uncertainty element out there. There is a global recovery, like you see US, UK are in much better shape than many of the other nations. So exports may do well. Commodities are at all-time highs. Commodity producers are doing well, like the steel companies that we see. So overall, it's not really a worrisome scenario. It is worrying on the COVID front, but on the corporate side, it is still something that you can live with. Once this is out, the corporates will start showing much better results, like we saw in the first quarter. When you're investing in companies, right? If you look at smaller companies vis-a-vis larger companies, there is definitely a move from unorganized to organized and smaller to bigger. That is what we have seen, right? If you look at smaller companies, net sales or their their wage cost, right? Smaller companies look far, far uh, problematic as compared to the larger companies today. Larger companies are much better, as you can see from the chart on the left-hand side. The year-on-year change, they are much in deeper red as compared to larger companies, which are neutral to positive, right? And look at profits of listed companies, right? Listed companies' profits have been increasing overall as compared to private companies, which tells you that there is a movement from unorganized to organized overall. And this really tells you the differentiation between large companies and smaller companies. The blue line is the large top 3 deciles of companies, and the orange line is bottom 3 deciles of companies. Look at the sales growth. The large companies have sprung back into positive growth on a year-on-year basis, whereas the bottom companies are still struggling with growth, sales growth in negative of 30-40%, right? Even in fixed assets, the fixed asset growth of the larger companies is still much better. They did see some shock in 16-17, but the smaller companies show a very big fall. And overall, they are doing much better in terms of larger companies as small companies. People do say that, mid cap is a place, but it is extremely risky in that, because you, apart from this move from smaller to larger, you also have untried businesses, untried management. So there is a higher risk in the mid cap segment. So when you are allocating money for your clients, you should allocate to that space, but make sure that that allocation is much lesser as compared to the larger cap. Maybe you can have 20-30% allocation to the mid cap, small cap segment, but not beyond that. You need to have risk control in place so that you don't go overboard and chasing that opportunity. So that was equities overall. So equities, say if you're investing for a long term, stay invested and look at larger companies more as compared to mid cap, which is a much promising space. Coming to gold, we saw prices rising significantly to 57,000 rupees for 10 grams, and now they're correcting to 45,000 rupees, and now inching higher to around 48,000 rupees, right? So what led to that correction was hope of economic rebound and some normalization, right? US bond yields had fallen to 0.6%. And from there, it bounced back to 1.6, 1.7, 1.8% in that range, right? So when yields increase, gold will get hit. But if you look at the significant rise in yield, the rising real yield, which is yields minus inflation, was much lesser as compared to the rising yields, right? For example, if you see that table, yields rose by 72 basis points between Jan and April this year, whereas if you see the real yield only increased by 32 basis points, 0.32%. So that really tells you that the driver for gold is real yields and not nominal yields. And as yields have started coming down and inflation going higher, that has led to, again, gold making a comeback. Another factor was dollar. Dollar, which was kind of depreciating during times of COVID, had a bounce back. See, no asset or no currency for that matter can keep falling or climbing in a straight line. And so happened with dollar. There was a bounce back in the dollar because yields were moving higher, and therefore money from around the world was moving as to park in the higher yield that US offered, and therefore the dollar was appreciating. And now with yields softening or coming down a bit, the US dollar has collapsed from 93 to around 90 again, right? So this chart really tells you that real yields is the driver for gold returns, right? Real yields, again, to remind you, is yields minus inflation, right? So on a inflation adjusted basis, if you're not making money in bonds, you better be an asset that will at least protect your purchasing power. and therefore people move to gold. So you look at the negative real interest rate scenario in 1970s and 80s, where you see that red line dropping significantly to -2, -4% kind of levels. That is when we saw a big rally in gold markets. Even this time, when we saw or even in 2000, after 2008 crisis, we saw negative yields. That is when gold kind of rallied significantly. Again, now when yields are falling, we are seeing again gold making a comeback and rising in value. So overall, negative yields are likely to remain. Central banks are not going to increase rates significantly. Therefore, we are going to stay with real negative rates, and that will propel gold prices higher. Another thing is the debt ratios. Because of COVID and even otherwise, the debt of developed nations has been rising significantly. And with COVID, they have been running far higher deficits, which will convert into far higher debt. And therefore, the debt levels that we will be staring at will be much, much higher. Something that we saw in the era of World War II, when because of the higher government borrowing and higher debt issuance, they had risen to around 120% of GDP. We are at similar levels. So what is the impact of this debt? This debt doesn't allow interest rates to rise significantly, because higher debt levels, higher interest rate will mean that you will have to pay a higher interest expense every year, be it at the government level, be it at the corporate level, or be it at the individual level. And I don't think that, in economies in the like US are already, even in good years, running a deficit of $1 trillion every year. They will not like further increase in expenses, which will lead to higher further increase in deficits, and therefore interest rates are unlikely to move higher. The second impact of growth, higher debt, is it starts impacting growth. So growth levels we have seen time and again, when debt increases to a very high level, it starts impacting your growth prospects. And therefore growth will be lower to an extent in the developed world. Look at the printing that these central banks have done. They have debased currencies right, left, and center. The blue line on the left-hand side chart is the US printing of money, the amount of money that they've created from 2007-8, which was close to $1 trillion. They are at around $8 trillion now. So they have created in last 12, 13 years about 7 times more money than what was prevailing at that time, right? And look at, they are becoming much larger portion of the GDP of their country. The US central bank is around 55% of its GDP. So central banks are printing a lot of money. They are debasing currencies, and this will have ramifications down the road. And therefore, you need to have assets like gold, which tend to protect against this debasement of currencies. This is a crude check in terms of how gold prices are. Is there any bubble in gold, or is this overvalued, undervalued? The red line is the money supply in the US, which has grown from 1974 till now. And look at the gold prices, it kind of tracks it. There have been periods of overvaluation, like we saw in 2010-11, when prices had moved significantly higher, much more than the fundamentals warranted. And then we saw a correction in gold prices. Unlike today, where if you see gold prices still look slightly undervalued to the money supply. And therefore, fundamentally, it kind of is closer to fair valuation, but doesn't incorporate what the future increases in money supply is going to be. Because we believe that central banks will have to be accommodative, will have to keep printing money and fund the governments that are borrowing money from market, because market is not willing to buy so many bonds. So it is going to be the central bank which will buy those bonds which are left unsold. So this is again the same thing, the debt and deficits in the US, which are rising exponentially. Even going till 2030, they are expected to make at least $1 trillion in deficit every year. And the impact of this is going to be a weaker dollar, right? So overall, when we have seen a weaker dollar, gold goes higher. Some point to us that, even in 2008, the factors were fundamentally more positive for gold. And still we saw in 2011, 12 onwards, gold prices started falling. What is different this time, and why gold prices should do well this time? So the answer to that is, last time it was only central banks of US and other countries which were kind of printing a lot of money, right? And it was staying in the monetary system because it was going to bail out banks and financial institutions in the US, right? It was not going down the real economy, right? This time, the money is seeping down the real economy overall, because government is making handouts overall to the economy, to the people, and people are going out and spending it. And therefore, the blue line, if you see in the chart, which was kind of inched up and then moved down, which is now rising exponentially this time around. And this is leading to inflation. And therefore, gold should do well this time, because inflation also makes people buy gold. And also from a real interest rate perspective, it makes real interest rates go down. Even today, the US money supply growth is still around upwards of 20%. So there has been significant money printing done by central banks, and that is going down to the real economy. That was a gold, which is looking fundamentally very, very attractive. Coming to the asset allocation quickly, people talk about various crises, and they have a terminology to kind of call each crisis as a black swan. Not all crises are black swan. Over last 26 years, since 1994, since the Chirag Mehta scam broke out, there have been 17 crises in India in terms of the capital market impact. And only 4, I would say, were kind of a black swan event. A black swan event is something that you cannot predict in advance, and therefore it is, as the name suggests, a black swan. Whereas most other crises that we saw were kind of predictable. The world was moving towards that, and therefore, it would have impact sooner or later on the economy, on the financial markets, right? For example, the 4 crises that no one could predict was 9/11, SARS, demonetization, which was something very, very not so good step by the government, and no one could predict it, and COVID. So apart from these, what we see across what happened in 2008, which was more or less written before it happened by many or predicted by many. So overall, only these 4 are kind of unexpected. But even 4 are many. It's like 4 out of 17, which is still something. And you need to be prepared for these kind of crises. And over and above that, when you prepare for this crisis, which is kind of, you need to have kind of something called as emergency fund built in. Something that the rest of the money that you go ahead and invest, there is no way to predict which asset in which year will do, how it will perform, because of those kind of black swan events or some kind of crisis which comes and hit us. Because timing a crisis is very, very difficult. You may predict that, we are going towards a not so good scenario, but at the end, the timing of it is very, very unpredictable. So like 2008 or be it 2020, where, COVID hit and markets really fell by 40% in just 1 month. Something that is unheard of, or very, very difficult to predict in a way. And therefore, you need to spread assets across asset classes. I think that's everything. Every one of us know that, but we kind of forget and try to chase the best performing asset class. This is very, very important. I mean, this statistics just pops up, and it's very, very important to keep always when you design portfolios, right? People say that equity is the best asset class. If you look at gold's return versus equity return since 2004 till now, gold has given about 1.1% lower return. But if you look at the volatility or the drawdown in gold, is much lower than what we saw in equities. So on a risk-adjusted basis, I think gold would have done fared equally or better than equities. But the essence is in building a portfolio which will give you a steady state of return and doesn't make your clients lose sleep at night, right? So if you had a pure equity portfolio in 2008, prices fell by 56%. In 2020, it fell by 40%. So those are the things that investors are not prepared of. So if you have a mixture of equity, debt, and gold in some proportion that either you choose it dynamically or you have a static allocation, the drawdowns are much lower. So instead of a 56% fall, if you showcase a client a 21% fall, it's more palatable for the client, right? And the volatility or consistency of returns is again very smooth. So it makes sense to have a diversified allocation at all times. And the best way to do it is bank on valuation of an asset class to drive that. And same thing that we do in a multi-asset fund that we have. So multi-asset fund, if you look at before COVID, given valuations were very high, we were at around 25-27% allocation to equities. And as markets fell, the valuations became very attractive. So in those kind of markets, you have to be very agile and bank on valuation, and don't be scared at that time that, if markets fall further, what do I do? We went and increased our allocation from 25% to more than 50% at that time to take advantage of that fall, because valuations were becoming very compelling and told us that you need to be in equities more. And that is what we exactly did. We disciplined, banked on our valuations, and went ahead and invested in equities. And as markets rallied, it started becoming a little more expensive and a little more risky, and we kind of reduced our allocation to around 25-27% again. So overall, we have navigated markets, and it's given investors much smoother ride in terms of returns, and returns have been very consistent. So if you bank on valuations, it's hard that you will go wrong. The fall that we saw even in during COVID was much lesser than what equities saw, and in the opportune time we kind of increased our allocations. So that's been a little conservative in terms of equity allocations overall, but we have seen steady returns, something more than what fixed deposits would give you, and that is what actually end of the day an investor is looking for. Give me alternatives. People are very disappointed with the returns that fixed deposits give you, and therefore looking for alternatives. So you can build those alternatives with using asset classes and Lego blocks and kind of increase decrease allocation to build that allocation for them, and give them a steady state of return, which is 200-300 basis points more than your fixed deposits. And it is a much smoother ride. So they end up taking a little higher risk, but that risk is compensatory with the returns that they will eventually end up with. And if you think all that is complex, what we think has really wonderfully worked for many investors who kind of ask us about recommendation, how they should go about building their asset allocation, we call it 12-80-20 strategy, right? 12 is your emergency corpus. You need to have at least 12 months to 24 months of money lying in a very safe place, right? And that's your emergency money. You don't touch it unless there is an emergency. And that is built because of the black swans that we see, or because of the crisis that we see. People may lose cash flows, people may lose incomes, people may lose jobs, and therefore they need something that can help them tide over that tough period. And therefore that 12 to 24 months of cash lying with them as sacred money is really helpful to help them during such scenarios. And rest of the money, you could split between 80 and 20, 80 to equities and 20 to gold. And we have been looking at this strategy since 2005-06, and be it the 2008 global financial crisis or be it the COVID crisis, it has worked wonderfully for investors. You kind of have to rebalance it periodically, but this has really worked. And of that 80 also, we will recommend that you kind of diversify across styles, across different types of equity assets. equity funds. And what we recommend is 70% in equity fund of funds, which is nothing but we put that money in that fund to external fund managers who are good, who we kind of identify through our research process, who are very, very consistent performers, who say and who do what they say in their mandates. And therefore, we kind of choose those managers out there. And 15% in the value style, which is a very different than the equity fund of funds, which is more growth oriented. And value fund is more value fund, which is kind of conservative allocation to equities. And 15% to the ESG fund, because sustainability is becoming very, very big. And we have seen that sustainability as a driver for long-term performance has been much, much bankable in terms of getting you that long-term returns. So this gives you a good mix across styles, and that is what you should eventually aim at. The 70% is kind of mixed between large cap, mid caps. 15% is kind of a multi-cap, flexi-cap kind of thing. And even the other 15% is a multi-cap, flexi-cap kind of exposure. So if you do that 12, 80, 20, or depending on how your client wants it in terms of safety, that 12 could increase to 24, 36 even. And the rest of the money can be split between 80, 20. And this works wonderfully well for investors. So with that, I will welcome any questions that you may have on this.
Will you please take over from here? Because I can just kickstart the discussion by saying that this will be a standard asset allocation pattern which you have just explained, or you keep on taking tactical calls depending on the market behavior?
Sure, that's a very good question. I think what depends is you choose an approach. Firstly, the approach either is a static or a dynamic, right? I think dynamic works wonderfully well, but some investors kind of find it a little cumbersome in terms of trying to gauge which asset class and when and how much, right? So if that looks like cumbersome task, then I think that simple strategies also work for investors. But at sometimes that 80% allocation to equities, sometimes, we know that equities will recover and do well because of the growth prospects of the economy. But, at sometimes taking that fall in equities in a significant manner, like 2008 crisis, where it fell by about 50%, it becomes just too much. So probably dynamic allocations work much better. And that is what we do in our multi-asset fund as well. We kind of dynamically shift our allocations. So I think that will work much better, because even if you look at today's market, right? Today's market, the valuations are such that it looks at a picture perfect execution by companies, and there is no element of any disappointment today that has been built in by the markets. So the short term, it looks a little edgy overall, and therefore it is prudent to reduce your equity allocation. But if you have a very long term horizon and you're not swayed by certain market movements which can last for 1, 2, 3 years as well, then you can use that 80-20 kind of allocation. But otherwise, it has to be dynamic.
We have one more question by Harshvardhan. Going by the title of the session, what are the changes to be considered in the pre-COVID and the post-COVID era with respect to the asset allocation?
Sure. One thing that has been come to light very, very importantly, and what we have been observing over several different crises, is that building of that emergency corpus, which has become more receptive, which was known earlier, but it has become more receptive with clients that, given the uncertainty that we are seeing, one needs to build that emergency corpus, be it 12, 24, or 36 months of your expenses. Second point about that is, at this point in time, post-COVID, I think given that the uncertainty still lingers around, and uncertainty more regarding the government policy in terms of how they will navigate overall in terms of either we are reaching the herd immunity kind of status, and that is going to be a very, very painful for the economy and for everyone, and various people will go through emotional toll along with that. It is prudent that, unless there is clarity on what the government approach is, reduce your allocation to equities at this time. And once there is clarity that, we are reaching towards that herd immunity or better way in terms of vaccination progress or a vaccination aggressive plan that government comes out with, please go ahead and increase your allocation to equities. That is what we have seen in markets like UK, in US. Once you have a surety in terms of the economic rebound, because the issue at hand is tackled more meaningfully, that is when you need to go ahead and increase your equity allocation. But otherwise, it makes sense to be a little prudent at this point in time, because the way it stands today, there is indecisiveness. We will go with a start, stop kind of pattern. And therefore, markets, if you look at the global press today on India, it has been really bad. It paints a really bad picture of India. And these foreign investors could become a lot more nervous on India as a destination for the capital. And if that happens, then you will see a lot of FII outflows, and therefore, that risk of equity markets taking a hit in the short term is much more serious. So at this point in time, maybe you can lower the allocation, and as confidence builds in the government strategy, you can start increasing your allocation.
Right. One of our members, Mr. Nilesh Mahajan, he is saying, what should be the asset allocation for a client who's going to retire or already retired?
So if, as you all are experts on this, the idea is to lower the risk at that age, right? Because depends on how much they're banking on it. If they're completely banking on the corpus to help them tide over the remaining years, then probably it has to be very conservative. And I would say that something like a conservative allocation, which has very little equities, is the way for them. So something, either you have that kind of strategy, or you have someone who kind of dynamically allocates and gives you that steady state of return. So that's been also the idea behind our multi-asset fund, where we kind of try to ensure that we don't take overt risk, and whenever we cite a risk, we refrain from taking it, right? It's a similar kind of strategy has to be adopted for a retiree, and they have to be very conservative in their approach. So at all times, they have to be very low allocation to equities. And that also can be much measured. Like at this point in time, like in the multi-asset fund, we are 25% allocation. They could be even lower, maybe say at 15% allocation. But someone who kind of refrains from taking risk, that kind of funds or that kind of assets would be a better way. Whenever there is a risk, you kind of step back and reduce your risk to that asset class.
Okay. Many of the investors, they ask us to book the profits with reference to, when the markets rises. So what are the factors we should consider before taking such action?
Yeah, so depends. Certain times it depends. A call is tactical or a structural, right? If it is a tactical call that they are asking to, and they don't mind coming back in, so we have seen time and again, that there are still statistics out there that you tell no matter when you come in the equity markets or the long run, you have made money, right? But there are opportunities, and if you bank on valuation as a metric, and also I would suggest that a forward valuation metric is very important. So if you're looking at a backward looking at a trailing PE of market, it suggests that you should be off equities and equities should be 0% in your portfolio. But that is masking something which is gone behind, and there is a quarter in there which is a loss-making quarter, and therefore it is not telling you the true picture of what's going to happen in the future. So what we do in our multi-asset fund, for example, we bank on forward valuations, and forward valuations derived from our on-ground research, which is looking at each company, and on each company we have a sell price. And from looking at the price today to the sell price, we know upside potential of each stock, which we built into a portfolio and therefore upside potential of the portfolio is available to us, which we use as a metric because it is more forward-looking, on-ground work, and that tells us how much we can bank on it, right? So, so look at forward PE as a measure. It kind of gives you some good insights into what you can expect in the future. And mostly assumptions of market are sometimes very, very optimistic. If you look at the brokers who kind of give their predictions on stock markets or stock prices, they are very, very optimistic. So you need to tailor down or trim down your expectations from those assumptions or those calls that they have given. And I think that will not disappoint you. So look at the forward PE as a metric. That has worked wonderfully well, the forward valuation. And that is a much bankable. So if your clients are asking you to trim, you can look at that metric and tell them, no, there is still potential. Forward will tell you that over the next 2 years, what is the kind of return that you're making. So if it is significantly larger and includes your bond plus a risk premium, so if it is more than 13-14% return, then I think it is better to stay in equities. And if it is lesser than that, then you reduce your equity allocation.
Okay. Another member is asking us, what should be the frequency of rebalancing and factors for basis of rebalancing?
So rebalancing will usually come when you follow a static allocation, right? In a dynamic allocation, you're already taking calls in terms of moving across asset markets in a proportion that you think is right. So in a static allocation, at least a yearly rebalancing is much suited, but it could also depend on certain market timings. Like if you see there is a significant fall in equities like we saw in March, that called for certain rebalancing because the movement was so large that it made sense to kind of deploy something back to equities. So either you can take a measure of 20% and any move beyond 20%, I'll do it. And if not, then yearly is a good way to do it.
Fine. One more question from Harshvardhan is, what should be the proportion of international equity in a portfolio? And should crypto be a part of the portfolio?
That's a very, very good question. I think international equities serve two purposes, right? One is it gives you the diversification against rupee depreciation, and it gives you diversification against Indian equities because there are two different markets involved. So you're banking on growth of two different markets, and therefore saying that, it will help if India is not doing well, at least that economy will do well and therefore give me returns. So in a way, the diversification from rupee is already available in assets like gold if you're invested in that. India is over the long term is a much better growth economy as compared to any other developed nation. India will grow much better, and therefore the return prospects are much better in India as compared to those growth markets. But having said that, if you like to invest in foreign equities, if you think it is desirable, and if I think one should do only when there are more dollar-led expenses, like if you want to send your son, daughter out to US or other nations for studies, or you plan to spend significantly larger portion in holidays abroad, then you can hedge that through those kind of exposures. But within that 10 to 15% allocation that we recommend for gold, maybe a 5% allocation could go to foreign equities, and remaining can be with gold. So that is what you can have as an allocation, because the rupee hedge is already available in simple instruments like gold. And also the growth prospects of economy in India are much better than the foreign equities. So that is the way you should look at it. And in terms of Bitcoin, I think Bitcoin, according to us, doesn't have any intrinsic value. There are currently so many types of cryptocurrencies out there. You don't know which will last, which will do well. Bitcoin has a first mover advantage and getting popular by the day, and therefore doing well. You don't know which other currency will knock it out, which other cryptocurrency will knock it out tomorrow. Because overall in crypto, I don't see any intrinsic value. Secondly, it's a direct competition to central banks currency, the fiat currencies that we have. And governments will not like a competition. I mean, we are already seeing that, the central banks are getting wary of these cryptocurrencies growing, and they are putting checks and balances in place such that they don't kind of disrupt their fiat currency market. Second is, a lot of these currencies are also used for funding certain type of activities which kind of are not desirable. So there are anti-money laundering kind of checks and those kind of checks going out for users of Bitcoins and stuff. So overall, taking all three considerations together, I think it could be like a bubble in the making overall, given that there is no intrinsic value. We have seen such bubbles in the past, like the tulip mania. I'm not saying that crypto overall as a technology is bad. It is very, very good. It does make a meaningful transformation. But overall, cryptocurrencies in today's shape and form are risky. And overall, central banks are coming with their own versions of cryptocurrencies, which will be nothing but like a fiat currency. And when they come with it, I don't think that they will want a competitor out there.
Okay, we'll just wait for a few more questions. I don't think there are. Okay, this one last question is basically most of our clients, they disclose the entire portfolio, but there may be a few clients here where they don't disclose their entire portfolio to us. So then how are we as their distributors approach the asset allocation and give meaningful action points to their clients?
Sure.
The entire portfolio is not this. Of course, most of them disclose, but there may be few of them.
Yeah, I think it is difficult because, if there is not enough information, there are not enough good steps that you will be able to recommend. Like what is happening today in terms of taking an analogy from COVID, we are under-masking the right numbers, and therefore there are no good policy measures being taken place. Similarly, in that context, in portfolio as well, I think you need to persuade clients to give out full data, and if you think that full data is not available, at least some glimpse on the exposures that are not available to you, so that you can at least plan for that. But again, it is saying that not enough information will not lead to the desired results.
Very fine. I think there are no more questions as such.
So even otherwise, you could reach out to us and happy to answer any queries.
Definitely. Yeah, fine. In PIFAA, our endeavor has always been to train, educate, and communicate proactively with our mutual fund distributors. On behalf of PIFAA, I, Beena Shetty, the Vice President of PIFAA, take this opportunity to thank Mr. Chirag Mehta for such an enlightening and informative session on the very relevant topic, asset allocation pre and post-COVID-19. Mr. Mehta has aptly covered the impact of COVID-19 globally and in India, its impact on the performances of different asset classes and thus on our investors' portfolios, thus bringing out very well the importance of asset allocation. I thank you once again, Mr. Chirag Mehta, for this amazing session. On behalf of the PIFAA core team, I thank Quantum AMC and for organizing such an awesome session, and all our PIFAA members who attended the session today. Stay home and stay safe. Thank you.
Thank you so much. Thank you. It was a pleasure.
Yeah, same here.
Thank you so much.
Thank you.
Thank you for this.
Yeah.
Well, everyone stay safe.
Yeah. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.